Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial. In this video, we're going to talk about GameStop stock and specifically a huge update, which is that Michael Burry is long GME. We're going to read through the article. I'm going to react to what I think are some of the most important takeaways from what he shared, and also just kind of watch the scam hours. The stock up a nice amount today, and really year to date is up 22%. I mean, that's a great feeling. We love that. So I'm excited to dive into it. Thank you. If you've already read the article, then hopefully you'll at least glean from my reactions what I think are the most important for GameStop fundamentally, because obviously on a technical basis, hey, great to see some momentum. We also did see another insider buy get filed. So Larry Chang, 5,000 shares. You love to see that. We also, in our Budget for Life Infinity Pool, are up to an 11% gain. So way to go, us, locking the float. So technically, we are encroaching on the 5-year anniversary from the sneeze, and we've seen 3 or 4, 2 Ryan insider buys, 2 Allen insider buys, 1 from Larry Chang, another purchase that was filed on Friday from the Turkish race car guy, and now we see Ryan Cohen announcing that he is also long GameStop. We closed significantly above Max Payne this past Friday. A little bit of maybe settlement in today, but maybe some momentum pushing into this week, where Max Payne is again this Friday at 21. So a lot to be excited about as far as the stock, right? The share price movement. But in this video, we're going to try to focus on, is there anything we can learn? Is there anything that's important as it relates to our fundamental analysis of GameStop based on Michael Burry sharing his fundamental bull thesis for GameStop, basically? So excited to dive into it. At the very least, it's enjoyable, right? Green days, we like those more than red days. So, hey, you got to love that. But we're going to see if there's anything kind of value shifting as well. So before I get into it, I'll, of course, respond to some comments. Also, just want to say thanks to everyone for being here. Thanks for the subscribers, all the love. We are on a mission to scale Mount Fuji, which means we're trying to get 3,776 subscribers. We are on a march to get there. If you want to be a part of the Pokey Sub Club and scale Mount Fuji with us, you're welcome to be a part of it. What's up, RG? What's up, Patrick? John today, great to see you. Great to see you. I did see that comment, Ryan Cohen's tweeted. He said, "Hey, any Wall Street analysts worth speaking to or whatever?" And I'm not a part of Wall Street, so he excluded me. But I thought, there is someone who's actually analyzing GameStop pretty well out there, Ryan. His name is Budget. What's up, Scott? What's up, WJP? Thanks. He said, I've been refreshing YouTube, waiting for this to drop. Glad you're here. He read the article from screenshots on Reddit. And yeah, we recreated it on a Word doc, and it's a little bit easier to read this way. He includes some pictures in his article, but none of them were like super important as far as the text that he's communicating. He does reference them a couple times. But anyways, this is just the text. I didn't screenshot every picture because I don't want his presentation. Some of the pictures I feel almost like make it more difficult to with what he's communicating from a text perspective. So anyways, we'll go through the text today. But if his I guess like presentation ends up becoming the viral moment that forces the next technical bull run, then maybe we will go through the time to make this document as pristine as possible. But I'm not trying to step on Burry's toes and come at any of his subscription money, because he does paywall his articles. So, hey, this is just the text. It's not the full experience. And also, hey, my face is here and I'm just reacting to it. I'm not just trying to, repost his content without adding anything as far as perspective. So we should be good as far as, internet kosher, right? What's up, Jonathan? Glad you're here. So without further ado, I guess let's dive into it and see what rises to the top as far as worthwhile perspectives. Final stop, GameStop. Could have been a little more clever there, but the jig is up. So I'm excited. Before we get started, some of you GameStoppers may doubt my Collectibles bona fides. So he shared I guess I could find that real quick. That one specific picture. Here you go. Here's his Spider-Man. He's like, look. So I like that he's talking about collectibles off the jump, because obviously that is a substantial part of GameStop's long-term valuation, at least as a retailer, right? The software and hardware are fair valued at maybe altogether $3.2 billion. The collectibles portion is valued already more than that, at more like a $4 billion, as far as what I would call the weighted average fair value on the present day collectibles business, which does not include Power Packs, right? Power Packs is separate over here, which I would give a present valuation of 1.6. All right, but let's see what Michael Burry says. He says, hey, which by the way, I will try to be attentive to the chat, but I'm going to be going through this article. If you got anything really important to say, maybe try to at me or drop a super and I'll definitely see it. But I'm going to try to focus on the article. No pressure, of course, for the supers. We're not here to gouge you of your hard-earned dollars. I'm here to add value to you. Hopefully give you something, not take from you. With that, here's his thing worth $500. Great. And he used to buy baseball cards. This, I thought, was an interesting statement. He says, it was a good introduction for a young Michael James into the world of the limited supply of collectibles. I will save further discussion of this for now. So this to me is like a little bit of Michael Burry giving a red flag that he doesn't think he's not long-term bullish on collectibles. He's saying that essentially the valuation of collectibles, right, the actual graded cards, is, he's not necessarily saying it's a spike, like some type of whatever, like it's going to come crashing, but the perceived store of value argument, he is too old, right? He grew up in the era of way overprinting and not anything being graded. And so he's kind of, that has significantly, his personal experience has significantly skewed his long-term thesis on the viability of graded collectibles as a store of value, because he perceives them as a fake limited. He sees the value in the supply being limited, and he sees that limited supply as fugazi. I think the value of graded collectibles is not inherently and only specifically tied to the limited nature of the supply, because each supply is unique when it's graded separately, right? It has its own card with its own number and ID, right? I don't think the value is strictly based on how limited is the supply. And I also don't think that the supply is unlimited. Like, we know within every specific collectible, you know how many exist, right? But so anyways, he might be a little more bearish. Let's move a little faster here. So here we are with the second and final post in the GameStop series. In part 1, he talked about the sad sack bum called GameStop before it blossomed into the retail trader shooting star. Nevertheless, my conclusion of part 1 was a bit of a warning for the eternal short squeeze enthusiasts. I had seen buybacks shrink shares by a third in the setting of 100% short interest. So he's saying that 100% short interest was caused by the buybacks and the reorganizing of the board of directors and the selling of Spring Mobile. All were home run / slam dunk activist successes with concrete results, but zero impact on price or short interest. So I disagree with selling Spring Mobile was slam dunk. Obviously, if Michael Burry feels that cash was necessary to create the squeeze, fine. But for the long-term fundamentals of GameStop, selling Spring Mobile was falling on the sword, in my opinion. Regardless, Michael Burry's saying essentially the GameStop of old was purely a short squeeze play. And he's about to tell us that right now it's not a short squeeze play, I think. I haven't actually read this yet. I'm doing it live with you guys. 5 years, because I wanted you guys to see my reaction. I didn't want to be premeditated. But if at the end of this you're like, hey, make another video where you just give your 5-minute version, if you're here and you're wanting that, maybe just skip to the last 5 minutes of this, if you're watching this after the fact. But for those that want to be a part of the experience, you'll probably learn more learning together. 4 years ago, GameStop was about $40 per share. Then it hit $183, a heck of a short squeeze. Short sellers can enjoy a short squeeze as well. Believe it. Then he shared a screenshot of him. He shorted the squeeze. I mean, these are emails where he is confirming that he shorted the squeeze. So he also sold before the squeeze closed. So I'm glad that he at least made money on one side of it. He did make money before he sold, but he sold in like the November, December, January, like the pre-squeeze run up. I think he doubled or tripled, but he could have, he could have made a lot more. Anyways, he makes plenty of money. The top frame of the chart shows the above short interest, the days of volume, etc. The total short interest finally perked up in April 2024, rising to 64 million shares. The stock broke to new post-big short squeeze lows, right? So it fell to the downside to just about $10 per share. Trading volume was very low. Short interest kept rising. It was around this time that Keith Gill, wow. Thanks for giving, I'm just going to bold that. Keith Gill getting a shout out. Returned to the scene after a 3-year absence with a cryptic message. He disclosed a large position in GameStop stocks and calls. Perhaps he was responding to those 20 plus days to levels similar to when he put on his pre-big short squeeze GameStop position. The stock reacted to his return with, incredibly, another short squeeze. The stock had already doubled in the 3 weeks leading up to Kitty's return. The stock opened on May 13th and tripled from the prior close to over $60. Who was there? Was anyone else there for that? I was there. That was a very fun time. GameStop was ready. It thought. Man, did we ever think it? Did we ever think in April of 24, when GameStop posts a net profit, right? A net income profit, right? The full year numbers had just come out for 2023. we are finally, for a trailing 12-month net income positive. It felt like obviously the future growth of GameStop is finally going to be appreciated. Obviously, the imminent doom bankruptcy of GameStop is officially dead. The nail's in the coffin. And so obviously we are going to begin rallying to appreciate the fundamental progress that's happened and the future growth that is inevitable because the bleeding has stopped and the shorts haven't closed, right? Did we ever think that that was the case? It turns out that wasn't the case. It was more like a short squeeze event that had a very short shelf life. And we still had another 2 years or a year and a half of fundamental growth necessary to get the company to a point where the actual valuation is genuinely incredibly attractive from a trailing 12-month fundamentals perspective. I mean, that's just taken so long. And of course, GameStop sold stock. 45 million shares for $933 million. And in June, they sold another 424 for $2.1 billion. On September 10th, they sold more shares again. So we saw cash grow substantially over this period of time. The convertibles as well. Maybe not. GameStop had been properly positioned to take advantage of the short squeeze, but the mechanism for selling so many shares at a time did GameStop no favors. The $3.5 billion raised was good, but it might have been more with better timing, and crucially, if trading volume supported the sales better. This sentiment is shared by every technicals bull. Like everyone that is in on GameStop because of the short squeeze of 2021. This is like, it doesn't mean Ryan Cohen's done a bad job, but Michael Burry is like really encapsulating a sentiment here that a lot of people agree with, which is that Ryan Cohen sold out the short squeeze opportunity for the fundamental opportunity. And the short squeeze opportunity was potentially there, right? Michael Burry is saying that it could have done amazing things again, but they sold so many shares into it that it took all the steam out of the short squeeze play. A little over a year later, GameStop devised a strategy to pre-position itself to monetize volatility automatically at a better price. True. So Burry's saying, if only you had thought of that a year before, right? October 7th, 2025, every shareholder received a 1-year warrant to buy GameStop at $32. We know this. This way, if there's another short squeeze before October 30th, 2026, GameStop would issue shares to the warrant holders at $32. Right? So it's a guarantee. Like, here is how we will raise if we have a short squeeze moment, right? They raise 1.9 billion. Shares climb as high as they want to go. Oh, and the float climbs, right? Another 95 million or so. If a significant number of warrant holders do not exercise, those that do exercise will get a bump in the percentage of the company they own. Welcome to Ryan Cohen's GameStop. Ryan Cohen. He talked about how he arrived on the scene. Let's look at the business as it stands today. Great. The business. Market cap's $10 billion. It's 480 million shares. Fully diluted count is all the way up at 592 million. And that's not including, 592. What is that? That's just the convertibles. So technically that is the diluted float currently. But if you add in the warrants, that's another 60 million. And if you add in Cohen's comp plan, that's another 172 million. So technically this is the fully diluted float right now because these haven't happened yet. But there's a lot more dilution than just the 590, unfortunately. All stores are operating on leases, no other significant debt, no covenants to worry about. Free cash flow was a whopping 569 million, or operating cash flow less capex, in the last 12 months. That is the best measure since 2014. That's just beautiful. Interest income on the big cash is helping there. The peak on the stock back then was $14.40 per share. Today, GameStop trades at $21. Nevertheless, GameStop does have a strong cash flow. Short interest is typically taken from Bloomberg. GameStop is a special case where short interest is, in theory, one of the potential catalysts. Therefore, we will closely examine this later. In 2006, I viewed elevated short interest as a red flag. I was mostly long-oriented then, except one engrossing short. His big short, obviously. Yeah, Burry was definitely right to call GameStop a red flag back in 2006. Next, the SEC filings review and business summary. Always start with the most recent 10K. GameStop was founded in 1984 as Babbage's, acquired by Barnes & Noble, spun out into GameStop in 2004. Correct. There's no undervalued property unlike its state when I approached it in 2018. Oh, so they used to own some of their properties, but now they lease them all. The asset and capital structure has been optimized after years of divestitures under Ryan's careful watch. Debt maturities are not imminent. The convertibles are so far away. Thank you, Michael Burry. There are substantial net operating losses approaching 1.2 billion, which are sheltering income for the foreseeable future. So their tax rate is in a nice spot, hence the 5% tax rate. Eventually, GameStop will have to pay more in taxes. But so far, they're only paying a couple mil, even though they're making some big dollars. $169 million in net income, only paid $6 million in taxes in Q2. It's pretty wonderful. Anyways, inventory accounting is actually average cost method, not LIFO or FIFO. There's no unions, no significant litigation. The disclosures on their 10Ks as far as risks are extensive. Retail competition, digital game delivery shift, Bitcoin volatility, meme stop dynamics, and short squeezes are all mentioned in their risk disclosures. The business historically is video game and electronics accessories retail. This peaked at over 6,000 stores globally about a decade ago. By February of 2024, there were 4,169 stores. A year later, 3,203 stores. And today it's probably going to be closer to 1,500, maybe 1,800 when they report in March. Clearly, the story today is to divest and not to invest for now. Capital expenditure is minimal, 1/10 of what it was in 2014. Never before has there been such a pristine maintenance capex. That's crazy to hear him say that. Never? That's basically, this is such a huge statement. This is basically Ryan Cohen saying there has never been a company that makes so much money that costs so little to run. Like, from a maintenance capex perspective, as a percent of what they are able to generate, this is basically a fancy way of saying GameStop is so lean and mean. It is so efficiently run from a capital perspective at its current state. Accounting changes involve crypto fair value, segment reporting. None of these are significant. However, GameStop has power-up rewards that require special revenue recognition. It's fairly vanilla, 57 million members, but only 26% of them are active. 5.6 million, or 10%, pay for Pro, which is 84 million in subscription revenue, a nice high margin stream. Nothing transformative and not a significant growth driver. Subscription revenue is a $15 one-year membership, recognized straight line over the subscription term. This is very simple. Thanks. The other revenue recognition element is loyalty points. Okay, great. Deferred revenue, also known as total performance obligation, tied to this program has steadily declined, mostly as a result of store closures, reducing purchase volume from 338.2 million to 192.3 million. The number of stores today is about 2,500. You are, well, he's including France in there, which is going to be gone. And the number is less than that, Michael. You'll find out soon. France is an active exit, which will leave US and Australia as the core markets. Store closures continue with no sign of abatement. I just love this. Love this. In February, Ryan posted this post about buying France. Store closures eliminate lease liabilities, free up working capital, and save costs. Impairments have been minimal. Store-related costs and depreciation decreased by $73.8 million and $18.1 million, respectively, primarily in connection with prior year store closures. Wonderful to see. Console makers have oriented to digital downloads of games. Physical games are on the out, changing the whole game. GameStop cannot survive on consoles alone, so it has worked to build up a collectibles business in its remaining locations and in the digital arena. The collectibles business is now about 32% of sales versus 17% recently. Growth in collectibles has been steady and fast enough, more or less, to offset video game software declines. That is so true. I have notes from 2019 showing the collectibles business back then was also about 30% as a broad category. So this is not entirely new or all that impressive. Recently, so confirmed, he's not as bullish on collectibles. Recently, a trading card push, particularly in Pokemon, has found traction as part of the post-COVID interest in collectibles. Nintendo Switch started in June 2025, and in mid-October, Pokemon Legends Z-A was released, which also drove Pokemon trading card volume. I see the physical collections business continuing on event-based cycles and the current boom fading in time, which will hurt comps in GameStop's collectibles business, even as the console refresh cycle turns down again. This is very interesting. So Michael Burry's saying, first of all, he's saying a couple things. One, he's saying physical games are on the out. Like he's essentially saying like GameStop's software business is uninteresting to him or unvaluable. The reality is it still has value, right? Even if it's on the decline, there's a portion of their business that is digital, right? This digital arena is not just digital collectibles. They also sell digital software, right? They are the preferred retailer for some portion of investors, right? So for Michael Burry to basically write off the software business, I think is a bit of a mistake. But this second sentence, GameStop cannot survive on consoles alone, is very true. In a lot of ways, they actually make much less on their consoles, right? It's a high ticket item, but the margins are razor thin. But it's what gets people in the door, and GameStop can sell games. So, anyways, Michael Burry, though, thinks that the growth that they've seen in collectibles will fade. He thinks collectibles as a market is event based. And I guess he's saying the event is COVID, or maybe he's saying the event is Pokemon Z to A, right? Like, I think this is just, I'm fundamentally in disagreement with Michael Burry here, which means that fundamentally, however he values his company, I would value it more just based on this alone. If he thinks collectibles, the demand for collectibles is somehow like primarily or only driven by Pokemon, first of all, and that it's somehow just based on the event of Pokemon events happening rather than what every other store of value is driven by, which is the fundamental need for stores of value, right? Every other collectible is a store of value, and the fundamental driver for store of value is inflation in fiat currency, right? It is money printing. The more that money is printed, the more that alternative stores of value will increase, right? Like, what have we seen from gold and from silver and from platinum in the past year? They're up double, triple from just a year ago. And he's calling Pokemon the boom and collectibles the boom, when collectibles haven't grown nearly as fast in the past year as silver, right? Like 300% plus. Most Pokemon cards are not tripling in value every year, right? They're up 4,000% since inception, right? Like from 3 decades ago to now, sure. But if you're talking about the hype in collectibles being somehow event based rather than driven by a fundamental demand for store of value due to money printing and inflation, which I'm positive Michael Burry thinks is a huge issue. He just doesn't think that collectibles are a viable part of that, or that fiat currency lowering in value. He doesn't think that is a fundamental driver for collectibles purchases. He thinks it's just a fad based on events, based on speculation, right? He's basically calling it Dogecoin. And he's saying that it's going to fade probably at the same time that the console refresh fades, which essentially would be like 4 years from now. So he's thinking that the console business and the collectibles business in about 3 or 4 years from now are going to look really rough. But he thinks GameStop has a runway of maybe 3 or 4 more years to do what it can with this undesirable business to buy some other business that can save the company. That's basically what I think what Michael Burry is getting at, which is a much more bearish position than I have on what GameStop has already achieved. And I just feel like we have a lot of article to get through, but I feel like his bias of the baseball cards, that anyone that's a collector knows, like, yeah, if you bought baseball cards in like the 80s or 90s, whatever it was, basically you got screwed. Like you didn't, it was a period where it was not profitable to buy baseball cards. Unfortunately, Michael Burry wasn't into Pokemon, right? If Pokemon was his hobby, he'd probably have a very different feeling about GameStop. Or if football was his hobby, right? He just happened to buy baseball cards during the 15-year period that it was really disadvantageous to be buying baseball cards as a store of value. Anyways, I feel like he discounts the efficiency, right? Never before have we seen such a pristine maintenance capex, right? And we're talking about $600 million in free cash flow. And he's like, yeah, so they're doing super great, but arbitrarily, I don't think they can keep it up. I think it's going to fade, right? He doesn't offer any reason. He offers a reason, which is, I see, right? His reason is his opinion. There's not a core piece of evidence that he's offering as why is collectibles going to fade, right? Like statistically, like, is there a fundamental reason for that? I don't know. I don't think so. That's it. Sorry, I'm reading some of y'all's comments about this. John today says, honestly, Michael Burry is highly uneducated on TCGs, which is understandable for his age. Yeah, definitely. He doesn't even mention rip and shipping, and says a new Pokemon game caused the boom. Yeah, he has no clue. LOL. Yeah. Jonathan Pickett says that he thinks he's referring to just a general market crash. Like, and if the market crashed, then that could cause the price of collectibles to go down, just like it could cause the price of gold and silver to be hitting recent highs. Yeah, I mean, collectibles are doing great. So ultimately, they are a hedge for a market crash. But it's possible that could be what he's thinking. But I think he just, like, he doesn't say a crash. He just says fading in time, right? Just and saying, comparing it also to the console refresh cycle, right? Not a crash. It's not like in year 5, Nintendo Switch 2 is not going to sell anything. It's just going to taper off. He's just saying there's not fundamental long-term demand for graded cards. Patrick says, pretty boomer take. Pokemon A to Z wasn't even received very well. Very true. John Doe says he is right. Pokemon was dead before 2020. Pokemon was not dead, okay? It is literally the most valuable franchise. Like, it's more value. It's like, was Mario dead? You know, was Nintendo's the brand that, like, any brand you can think of? Was Call of Duty dead? Like, was Star Wars dead? Like, Pokemon's like 3 times or twice as valuable as Star Wars. You know, it's like, obviously 2020, so much has spiked in, like, markets that people can touch, right? Speculative markets, gambling, for example, right? How many more sports betting apps are there now compared to 2020? So, of course, people basically post 2020 said, F this system. Like, I'm just going to try to, like, YOLO my way through life. And collectibles are a part of that. But so was silver, right? Was silver dead before 2020? No, it wasn't dead. It just wasn't worth, it was worth 20% of what it is now, right? So many markets. Was the stock market dead? No, but it's up a whole lot, right? Compared to what it was then. Anyways, let's see what he says about power packs. Some investors spy a new hope. So I'm already kind of annoyed. I'll stop talking about it, but like I don't agree with Burry's pessimism on GameStop, the legacy retailer. I don't. But Burry thinks it seems likely they'll make good money for at least the next few years, and then it seems likely that it's going to look pretty balls after that. I disagree with that bearishness, but that's basically what he's saying about GameStop, the legacy retail business. On the Andre says platforms with live auctions are also a big deal. So like Whatnot and eBay influencing millennials and Gen Z to get back into collecting, not just TCG, but also sports cards, also coins. It's just getting started. I agree, Andre. Okay, so spy a new hope. Let me just say, if I was writing this, I'd say another hope, but whatever. During the third quarter of last year, GameStop launched Power Packs. Yep. GameStop's customer margin is upgraded by selling suspense as the main product. It's true. It's a gambling adjacent entertainment product. The customer suspense is monetized through the mystery of buying unknown cards. Once revealed, these cards can be held in the digital vault or sold immediately for discount or physically shipped. GameStop makes margin on the mystery pack, instant buyback, and the recycling of cards back into packs. Love that. Love that. I'm a fan of the business model. Woohoo! Let's go. Oh, no. Oh, sorry. Let's go. He's a fan. Gambling and trading stocks have taken to gamification to unlock our brain chemistry to feed addictive behaviors. Now the games are coming to gambling to feed the same brain chemistry. So I generally agree with this. Some people use gambling as a negative word. In this context, I'm not. I think the gambling total addressable market is the market that PowerPacks lives within. And I think PowerPacks has several competitive advantages to its other gambling peers, which is in large part that people actually get a card, right? That like you are guaranteed some value in exchange for your purchase, and that value you receive will quite plausibly appreciate in value if you hold on to it, right? The fractional or vaulted collectibles market is not new and has a poor to mixed track record, but this has stirred some interest among investors. So I just, Burry, why are you so bearish? Why are you so bearish all the time, bro? It's not new. No one, like the bull case on power packs is not that the PSA vault is new. It's that it's incredibly more popularized and accessible now than ever, right? I didn't know that I could send my cards to a vault 5 years ago, 10 years ago, 15, 20 years ago, right? It's so accessible now. It's not new. It's just growing in accessibility. Whatever. Bulls project hundreds of millions in free cash flow without the cost of physical locations, labor, or geographic limits. Selling dopamine is a good business usually, and I do believe power packs are a clever and low risk endeavor. Exactly. You are selling dopamine. It's an entertainment business. It's not attached to physical retail. This is huge. So even though he's kind of like bearish on power packs, like he thinks hundreds of millions is like pie in the sky. Which, Burry, why would you call this pie in the sky when you just were looking at the business that you don't like, the retail business, and you're like, wow, they're doing 569 million in free cash flow. Like the business that you think is balls is doing hundreds of millions in free cash flow, and this business that you like, right, that you think fundamentally is exactly what people are looking to put their money on. You think hundreds of millions in free cash flow is somehow like hopium. At least that's what it sounds like based on his language. Below is a sampling of YouTube shorts concerning power packs. So he just, in the image, it was just like thumbnails of some videos. Yeah, there you go. Just some thumbnails. There are football cards too, but power packs for Pokemon dominate. I see a number of customers trying to put their stamp on a potential dopamine factory as content creators, but I have not seen signs of virality. So BURRY is measuring how many views do these YouTube videos get, right? YouTube videos tend to be in the high 100 to low thousands in terms of view. Shorts are even smaller than that. It remains early in the launch, but I spy no sign of viral spread. So BURRY's like bullish or bearish on power packs because YouTube videos of people opening them are low in view count. How many views does someone pay like playing the slots in Las Vegas get? Right? Like, I don't know, like casino pulls. Like this person wins the jackpot, and of course that gets 3.6 million views at some casino. But like if you were to filter by new, like just show me uploaded today. Like, look, some flip-flop casino. This one has no views. This one has no views, and it was posted 3 hours ago. Right? Like people know this one has 11,000 views. 37 no views. So anyways, why would you watch someone else play a casino when you could just play the casino yourself? And if you're Michael Burry, why would you base your valuation of a company on how many views the video is getting when you, like, again, he probably doesn't want to spend this much time on GameStop because he doesn't care that much about it, because he doesn't believe that much about it. But like you can estimate how much money they're doing through the actual pulls, right? Not the views on the pulls, but the pulls, right? Just like we've been doing on our channel over here. So anyways, whatever, Burry. Let's keep going. Pokemon games tend to draw in very young people as well as older people who may have extensive Pokemon knowledge. Yeah, he definitely is not familiar with Pokemon. Potentially neither use Google search nor X. What are you talking about? Is this his like sarcastic justification for why the YouTube views don't have more views? Whatever. To make hundreds of millions of dollars will take selling tens of millions of power packs. As a former card collector, I cannot imagine that. You are not a bona fide card collector, but whatever. As a man with a little common sense remaining in one eyeball, I cannot see that in the social engagement numbers either. Like, this is opportunity. I'm sorry for being sassy with Michael Burry. For him to say, based on my personal experience and based on what feels right to my head, I just don't like based on my personal experience buying like poorly made cards and my personal assessment of how many views their YouTube videos get. For those reasons, I don't think they can sell millions of power packs. Like, why don't you, like, that is crazy to me when you can look at the numbers of power packs that are sold. Like, which I know we don't have the actual numbers yet, and I am speculating over here, but I'm speculating from 4 different ways that he can do also, right? 4 different methods. I've talked about it in past videos. that all suggest that PowerPacks is actually doing a lot of millions of sales already, right? But he's just like, I just can't fathom it because I just don't think it will happen. And again, that's the reason I say that's opportunity is because this is how even a GameStop bull views GameStop's current opportunity in power packs and their current retail business. At the end of this article, I've read the last two paragraphs or whatever where he says that he owns GameStop. So he's long on the stock, and still he totally dismisses the retail business, and power packs he also totally dismisses. He's like, it's cute, cool, a little bit of easy money to make, but his reasons for pessimism are so subjective that it creates opportunity for bulls that are more bullish to look at this price movement and say, I'm not amused, right? This is nothing compared to what I think this company's worth, right? He says the cost is minimal and it could be he even says it could be a neat little business with a decent return on investment. That's just savage. Why are you, anyways? This is not going to age as well as it could have, Burry, but whatever. So far, it has not hit mainstream consciousness. That's definitely true, but time will tell. Even assuming power packs do reach a couple $100 million in profit in the next few years, I do not see power packs as more than a minor incremental driver of shareholder value at best on what is now a roughly $10 billion market cap. This is actually like fair. I don't know why he didn't say that sooner, but Burry's saying, hey, even if power packs does great stuff, like they already, like this company's already worth 10 billion. So how much is power packs really going to add to that? Of course, Burry's like much more pessimistic on it than I am. Like, I think if it's cute, then it's a cute little, $250 million bump, which is a 2-3% gain, right, from its current value. And I think there's a 30% chance that basically Burry's right, that power packs is ending up being worth something like this. I also think there's a 55% chance that it's a 1.2 billion, which maybe Burry would also call that cute or non-meaningful, right? I mean, a 12% gain, and that's based on right now. That's not what it could be. That's how I would value it right now, right? So I absolutely think it can grow beyond that. And upwards of 5 billion, which I'd say is certainly much more bullish than what Burry thinks is even possible. And I think there's a 15% probability that that's what it's already worth, right? Not how much it could be worth one day. And he's saying even one day, like even several years down the road, he does not think power packs is viable as a value creator. British, good morning. 4 a.m., you crazy lad. I'm glad to have you. Thanks for joining the live stream. I estimate hundreds of store closures happening at the moment. Traditional brick and mortar competition is not the issue here. It's e-commerce. That's true. Sometimes directly from the developer, right? Game makers, console makers can sell direct to consumer, have caused a slow but powerful decline. Very true. GameStop's way of doing business is dying. And no, the GameStop's old way of doing business is dying, whatever. And the businesses it hopes to invent or buy are not clear yet. So this is well articulated from Burry on what his thesis is. He thinks even the lean and mean, the CapEx efficient GameStop, he thinks is still ultimately doomed. And I don't agree with that fundamentally, that like Michael Burry is basically saying like stores are doomed. Like eventually no one will go to stores because every product maker will just sell direct, and it won't be economically viable to have a store unless it's your own store for your own products that you manufacture. And I disagree. I think there are ways. I think stores will still exist, right? 10, 20 years, 50 years, 100 years from now. I think there will still be some stores. I don't think it's dying, but I think it's changing and shrinking, and margins are more difficult to come by. So it requires a ruthless business model, but not imminent death is how I feel. Neither return on equity nor pre-tax margins suggest competitive advantage, which is not surprising. This is true. Like GameStop's not uniquely able to sell software or sell hardware for a higher margin than competitors. However, they do have their resale business. Like their trade-in business is a competitive advantage, and there is no retailer that competes at scale, right? Other than you could say eBay as like the decentralized version of that. But still, like GameStop has a channel for inventory that other stores do not have, and direct to consumer does not have. And then he says there's so much transition at hand that these historical metrics mean little. I like that he said that. That's important. The legacy GameStop is not indicative of where the future GameStop is going. GameStop does not have a defined pension plan or significant employee benefit obligations. This is positive and unusual for a very old retailer. We love that. Making this area less a bugaboo than it used to be. Still, always worthwhile to look and ensure these liabilities do not exist. No loan or debt issues. We talked about that. No litigation. Third quarter 10Q reveals a business in transformation. France divestiture is still pending. Canada's already sold. Warrant distribution just happened. The debt is at $4.2 billion at 0%. There's their shares. The company reported 6-year high net income of $421.8 million during the trailing 12 months. About half of that's interest income, and the other half is operating income. SG&A is down 24% year over year. Total cash is now $7.8 billion, not including their Bitcoin. Why do you just write off all their Bitcoin? Why would you write off all of it? And 7.8 seems a little low. Oh, he's also writing off their T-bills that are like 1-year T-bills or even like 6-month T-bills. He's not even counting that as part of their cash. He's only using the 3-month or less T-bills as cash. So he's discounting 1.5 billion worth and calling it 7.8. Whatever. Hey, greetings, Million Mountain from Singapore. Glad you're here. Governance improved immediately upon Ryan's ascension. The board is now right-sized and vulnerable to activism. I don't know what he means by that. Does he say that GameStop is vulnerable to being taken over by activist shareholders? Because I do not agree. Because one of the board members happens to be worth $7 billion, right? Like Cohen could fight off any bad actor trying to like buy their way into, and GameStop has $9 billion that it could do share buybacks with. Anyways, non-employee directors, restricted stock units. Great. No significant related party transactions. Compensation is modest. No salary for the big guys. Base salaries were cut for executives. Bonuses dropped. Great. GameStop has an agreement with Ryan Cohen that allows him to acquire up to 20% of the stock without triggering Delaware takeover laws. The board granted Ryan a big incentives-related options package recently. This is as clean as governance gets. An extremely loyal, vocal retail base of investors is actually the most effective takeover defense here. Good governance does not exist in isolation, though it's always nice when management isn't stealing from you. Hey, we got a shout out. The vocal retail base. Let's go. There are multiple Form 24B. Yeah, the zero. We got the convertibles. The company is clearly still interested in tapping equity markets if and when the stock jumps for no good fundamental reason, such as a short squeeze. I would agree. The company is definitely still interested in raising cash. It'll take all it can get. The sources were what we had in 2026. Today we get news from everywhere. No meaningful private comps. No buyout comps. Why don't you comp it to Best Buy? That's what I did recently. Looks pretty good compared to Best Buy. No financial buyer approach. Public companies are simply too different, and none are divesting / not investing. That's not true. Best Buy is very similar in a lot of ways, and they are divesting / not investing. They're closing stores too. Whatever. A hostile bid is unlikely due to the retail-based support of Ryan Cohen and due to GameStop's amazing execution. BURRY. More than that, there's no reason to acquire cash at a premium. By the way, this is also the fundamental problem with my MSTR, Saylor's Bitcoin Treasury model. Speak of the devil. As I write this, Ryan Cohen and one director have bought stock in the open market. Yeah, we've gotten a few more since then. I wonder why. Well, there's no change in trend. Ryan Cohen bought the same price back in April. Well, why didn't you update this before you posted? Because he bought again the next day and you posted it like 3 days later. Whatever. There are no earnings calls in the Ryan Cohen era. It's true. It's a sad thing. Ryan has instituted amazing governance protocols, but has set a new standard in public company communications, being opaque, or I think that's what he's saying. Opacity. Basically, not communicating anything. This is how Ryan does it. Bitcoin. Okay, I don't think Michael Burry likes Bitcoin. Move some into Bitcoin. He's not trying to be like Michael Saylor. True. That's an important point to communicate. Rather, he's just being independent, patient, and careful. An inflation hedge. He believes buying Bitcoin on a pullback is a reasonable diversification on a large cash base. Very true. Very true. Good afternoon from Hong Kong. Theme Creations. Welcome, welcome. Scuttlebutt. As a concept for investment research, the idea is to do some investigative journalism. Charlie Munger is said to have used this book to help Warren Buffett understand the value in great businesses at good prices. When I was running money, I took this to heart, especially early on, but I quickly realized the old ways were frowned upon in modern SEC interpretations. So I moved to doing more with less and focusing on filings. But now we have all these other ways to dig up scuttlebutt. For GameStop, so anyways, Michael Burry focuses on company filings, 10Qs and 10Ks, to research companies. That's what we do here on the channel, right? A little bit of digging up what we can find in the interwebs. But when it comes to how you fundamentally view a company, essentially 80% of Michael Burry's efforts and 80% of his view is based on the 10Qs and 10Ks, which is what this spreadsheet is based on, which is what this channel is based on. So if it's good enough for Burry, hey, it's good enough for us probably. For GameStop, employee reviews are not informative. Great. The most relevant is probably the conversation I had with Ryan over 5 years ago. How is that the most relevant scuttlebutt? A conversation you had with Ryan from 5 years ago. Whatever. And we didn't talk about GameStop much at all. How is that? That's not relevant. Whatever. I like what he's doing. I think he is doing what Warren Buffett did and what I am doing, essentially waiting patiently. Unlike me, he's doing it with a public company, which by all prior evidence is very hard. Let's go. 3.8 billion in revenue, solidly profitable. Market cap is what it is. Got all the cash, the convertible. Tangible book value is $11.84 per share. Share price is $23. Fully diluted, tangible book value would be less than $10 per share. Unlike just about every other company out there, GameStop is issuing shares, raising cash at every opportunity it gets. Not every opportunity it gets, probably, but it is raising cash. Shares outstanding have grown. It's true, as we've talked about. Because the debt has no interest payment, little reason not to convert to common stock. Thank you. Can someone I just want to pin that comment. Anytime I talk about how the convertible debt is going to convert, there's always someone that's like, you don't know that. It's a moot point. Burry doesn't even talk about it. He's like, there's no reason why it wouldn't, like the conversion price is $29.85 for the first 1.5 billion and then $29.91 or whatever for this 2.7 billion. So practically speaking, as GameStop moves up past 30 per share, bondholders will gradually convert. So he thinks there will be early conversion, which there are specific terms for on the convertibles tab here. So good to know. If you're a friend of the channel, have access to the sheet. Burry thinks they will exercise their opportunities to convert early. And if GameStop wants to, it could also pay back early. GameStop may still trade at 23 to 28, and the bonds may still trade well above 100 on option value. I expect that if this is the case, Ryan Cohen will force the issue. He in no way wants to pay these bonds back and sacrifice that cash. Thank you, Michael Burry. If for some reason GameStop stock is getting close to the early payback period and it is still trading sideways from 23 to 28, guess what Ryan Cohen can do? He can buy a crap ton of GameStop shares with his own money. He can buy a crap ton of GameStop shares with GameStop's money. He can force the upward movement on the stock within reason, at least to get over 30, right? Like it's not, the convertibles will convert. It's not going to be paid back in cash. Anyways, thank you, Michael Burry, for that. The stock is trading at more than twice its net asset value. It has a dying. The business is not dying, okay? But maybe he's saying like, even though they're executing so well, that they're in a like he thinks that stores are all dying businesses. Even the best stores in the world, 100 years from now, they will die, right? Which every business dies eventually, right? So, whatever. But he thinks retail is a dying business, period. And Power Packs is just cute. It is very hard, nay, impossible on asset valuation alone to justify the current price of the stock. There is more to this story than the assets currently on the books, and we will pick this up later. Well, duh. Like, basically, Burry, what Burry just said right there is, hey, right now, there is enterprise value, right? It's not just the hard assets that are being baked into the market cap. People are also valuing this business. Like this market cap, he's not saying it's overvalued. He's saying this market cap of 10, 11 billion there's no way you can argue that they're getting this market cap just because of their cash, just because of their physical assets, their Bitcoin, their inventory, and their lease assets. Like he's saying, there is some enterprise value that is baked into this market cap, right? And he's saying, now why, like, what are people valuing in the enterprise? I'll tell you more in a little bit. But just so you know, people value the enterprise, or at least the market does. It's not just here are the assets it owns. The potential catalysts seem obvious. Ryan Cohen has control of the company. I love how the potential catalysts seem obvious. The very next statement made, Ryan Cohen. Like, this is the same thing that DFV said in his live stream from however long ago, where he, pretended to be injured and all that stuff. Yeah, what's up, Battle Rat? And he said, like, look, pretty much like it's just, do you believe in Ryan Cohen or not? Like, that's where we're at. And that was a year and a half ago or something now. So we do have more to go off of now than we did back then. But this GameStop still has so much undeployed cash and so much uncommunicated vision and plans that Ryan Cohen himself is still a central part of the bull thesis. Hopefully, a year from now, 2 years from now, Ryan Cohen is a part of the bull thesis, but not the linchpin. Similar to Tesla and Elon Musk, right? 5 years ago or 8 years ago, however you want to call it, Elon, like, to own Tesla was to bet on Elon. And if you did, you were proven, you were rewarded, right? Handsomely. But now Tesla's at a place where they could let go of Elon if they wanted to. It would take a hit, right? Or like Berkshire Hathaway with Warren Buffett. Like, he's retiring at the end of the year. Their stock's not going to just go to zero all of a sudden. Like, they're past that stage where him staying is a premium option value, right? Like a little bit of just extra multiple in the market cap based on we have a genius running the show, or we have Ryan Cohen running the show. But if hopefully the company matures to a point where, hey, we're not just betting on our leader, right? Anyways, let's keep going. He's laid booby traps in the convertibles. That's true. He is waiting to buy something. That could be a catalyst. It's true. Oops. Also, the physical retail business is a catalyst, and also Power Packs is a catalyst, but whatever. In a frothy market with Bitcoin, even another Bitcoin buy might do it. this could be a catalyst. Setting off all the booby traps to rain cash down on GameStop. Burry's basically saying, look, the next step GameStop has to do is just get this number to be over 32, right? If this stock goes over 30, if it goes over 30, then all of a sudden, GameStop's net cash position goes from 5.4 to 9.8, right? They gain 4.2 billion in market cap from the convertibles diluting in net cash, right? So if the enterprise values remains valued at 5.2, then all of a sudden this stock would become a 14, $15 billion market cap just based on the convertibles. And if the convertibles do that, well, guess what? Then the warrants are in the money. So there's another 2 billion coming. And if the warrants get in the money, then guess what? They're S&P 500 eligible. And also guess what? Now we're talking about the comp plan and Ryan Cohen's 3.5 billion that he may very well be paying cash to GameStop for his comp plan, right? So Burry's just saying, hey, when we've talked about this on the channel so many times, but he's just saying the map for GameStop to get just another 2 billion or so in market cap, there's any number of ways, if they're patient, that they can make that happen. And once they make that happen, they basically immediately are essentially worth twice as much, 80% of that happening just from cash, right? And then a little bit of technical S&P 500 inclusion that I'm just placing a 20% premium on that event happening, but likely that would be an even higher premium, especially if there is still a substantial short interest out there that's not even being reported. Anyways. And then, thank you, Michael Burry, GameStop can raise even more of that 0% debt, right? They can do it again, right? With even better terms at even higher targets, or maybe targets that are only modestly higher to keep the music playing, while planning to eliminate the debt by issuing equity. This seems like a rinse and repeat deal. This could be a catalyst in good news on the Power Packs front, Power Packs, with a new fad or continued growth. Oh, I missed this hilarious line here. So they could buy Bitcoin. He's like, you know what else they could do? Either me or Ryan or Roaring Kitty could do something to pump the stock. JK, I would never. Right? So Michael Burry is not going to pump and dump. Okay, but he did just release this. And anyways, I like the map that Michael Burry is communicating here as far as the coming months and years for GameStop, which is that Ryan Cohen has set up, he's calling them booby traps, right? But between the convertibles and the warrants and his comp plan, right adjacent to S&P 500 inclusion and his huge cash position and the incredible efficiency of GameStop, the company. And what Michael Burry would say is at least a 2 or 3 year window of resilient, cash-rich retail operation, right? There is plenty of time in that window to set off the trap to basically capture another 8 billion plus in market cap, which if it takes 3 years is not incredibly exciting. But I think what Michael Burry's saying is it's probably going to take 8 months or less, right? Like it doesn't take a lot for them to trigger some momentum and get moving in the right direction, right? Anyways, perhaps the most powerful catalyst is the anti-catalyst. There's almost nothing that GameStop can do now to disappoint. So like your language learning model today, this is probably the least this corporation known as GameStop will ever be. It's hard to imagine losing money from here over the long term on some sort of bad news, short of key man risk. Okay, enough. I think, by the way, GameStop's key man risk is negligible, right? I think in all of the worst case scenarios from a key man perspective, they have done plenty to where their downside is actually still higher, right? There's no actual downside fundamentally, but fundamentally they're valued so low right now that even Ryan Cohen not being in the picture or actively coming against GameStop for some crazy reason would still not be enough to stop the train and the trap that GameStop has already set in motion. But this is basically Ryan Cohen saying sorry, I keep calling him Ryan Cohen. This is basically Michael Burry's way of saying that fundamentally GameStop has a very high floor. Like it's hard. It's how could it stay this low, right? How could the stock stay this low? How could the cash flow stay this low? How could the enterprise value stay this low with the map that they've presented ahead? Which, by the way, that conversation becomes very different if GameStop is at $45 a share. Like post these convertibles diluting, post the warrants, post S&P 500 inclusion, you could then say it's possible that GameStop disappoints, right? If the business hasn't fundamentally grown to go alongside with how they've captured cash leveraging volatility, then you could say, wow, there is some downside risk here. There's still plenty of upside depending on what they have or haven't done from a fundamental perspective. But Michael Burry's statement here saying there's almost nothing that GameStop can do now to disappoint is tied to its current valuation. This is not an infinite statement that he's making, but it's a statement based on where GameStop's trading right now. It's essentially like the lowest risk, very meaningful upside investment opportunity that Burry has seen in a long time. And according to his statement earlier in the article, he's never seen quite like this. Potential for a short squeeze, not just a short squeeze, a mother of all short squeezes. Phantom short interest, ETFs, etc. Let's get into it. The allegation is that ETFs are being used to short GameStop stock in a way that's not reported. Yep, despite the low reported short interest. Many cite these other papers. Naked shorting. He summarizes the findings here. My read of the Naked Short Selling article is that ETF short interest is mostly 67% used for ETF market liquidity provisioning, 33% used for actually shorting. So that's one thing he's saying is, hey, only 1/3 of ETF shorts are actually to short the underlying. But that's talking in generalities. Like, I don't know. Anyways, I'm pretty sure Cohen's going to say, hey, the squeeze isn't going to happen. But if you're going to talk about what happens usually, right, most of the time, blank. If you're going to talk about what happens most of the time, like, I just don't know how that relates to GameStop, which is obviously a unicorn in terms of how shorted the company really was and perhaps still is, right? The damage that legacy shorts in GameStop have caused to financial institutions such as Archegos, such as Credit Suisse, right? This is unprecedented, right? This isn't like, well, most of the time, dot, dot, dot. It's like, why are we even talking about most of the time? We're talking about GameStop, like we're talking about they turned off the buy button, right? They tried Roaring Kitty in Congress. Like this is not a usual event. But he's saying usually, right, this is operational shorting in the ETF, not the underlying stocks. It's not directional. It's not used for hedging. It's just to fulfill settlement within the ETF settlement cycle, which creates sinister sounding phantom shares for a short period of time. None of them are held for long. But like insurance float, there is a float consisting of these phantom shares. And those phantom shares are technically naked. But that's different than illegal naked short selling. They will never be delivered because the trade is closed within the settlement cycle. So, although Professor Evans says that 70% of all FTDs are from ETFs, that operational shorting explains nearly all of those FTDs very innocently. His point is quite simple. Operational short selling is not illegal, naked short selling, and it's not a source of hidden stock interest for any stock, inclusive of GameStop. So I didn't read this article from Professor Evans, but does he talk about GameStop in the article? Is this it? No, he does not talk about GameStop. At least not in the slide deck version of it. Anyways. Is this it also? No, this is by someone else. Okay. I feel like BURRY is taking what should happen, what usually happens, and then saying, look, it can't ever happen otherwise. And I don't agree with his conclusion. Like, I agree with his conclusion. Operational shorting explains nearly all of those FTDs. Like, again, I don't have any argument with that. I don't think what happened with GameStop back in 2021 is what usually happens, right? Like, I don't think short selling is often like hidden to incredible levels to, finish off a company and seller box it. Like, I don't think it's usual for a company to get taken all the way to bankruptcy, like it's, of course, usually FTDs are innocent, right? Like, but we're not talking about usually, Anyways, Professor Evans also shows in the Phantom of the Opera article that ETF has no voting rights. That's great. Stripped voting rights can affect outcomes. If 5% of XRT shares are phantom shares, then State Street will vote 5% fewer shares across all of its underlying portfolio holdings. Professor Evans does not claim that phantom shares of the underlying securities exist. He says there are zero. Professor Evans also notes that ETF phantom shares retain cash flow rights, meaning they are guaranteed to receive any distributions or dividends and may sell the ETF without limitation. Right, but what about when GameStop does a stock split as a dividend, but then it's not done as a dividend within anyone's brokerage? Like I just feel like he's talking about the usual and not talking about what's happened with GameStop stock specifically. Not that it matters that much. I am also not in GameStop for the short squeeze play. Like, that was the play in 2021, but I don't think that's the primary or the only play in 2026. So I agree with Burry's ultimate conclusion, which is you can be long GameStop and not care about the short squeeze. You know, the fundamentals are there to support that. And in Burry's case, he's saying the cash flow that's anticipated to come from the coming dilutions, combined with the trust that we can have in Cohen's leadership, is enough based on current valuations to justify a long position in light of its high cash floor as well. Even though Burry doesn't fundamentally value any of the businesses GameStop's operating right now. But I don't I'm not convinced, I'm not persuaded yet in why Burry thinks a short squeeze wouldn't happen. I still think it very possibly could happen. Even though GameStop has diluted a bunch, I think that's really the strongest argument against a short squeeze is it has been 5 years and there are millions and millions of more shares in the float now and hundreds of millions more coming, you know? So it's not like I'm trying to say the short squeeze will definitely happen. I just don't know why you would take what usually happens and use that as a reason to think that it won't happen, if that makes sense. Another ETF issue raised by some investors is ETFs shorted in excess of their shares outstanding. For example, XRT is maybe most relevant. It's the largest retail-focused ETF. It's also heavily shorted as a hedge against consumer weakness. GameStop is 1.35% of XRT. Camping World is the largest at 8%. XRT holds just 424,000 shares. As you can see, XRT is far from the largest holder of GameStop. BlackRock holds 13 million shares. Relative to that, ETF, GameStop is a teeny 0.2% position in the mid-cap ETF. So XRT is a more efficient way to short GameStop. And it's still extraordinarily inefficient. As a rule of thumb, one must short $100 million worth of XRT to short a little over $1 million of GameStop, even as XRT's total market cap is just $673 million. This does not compute. There's also a thesis that shorting all of XRT adds to the short interest in GameStop, and this short interest would not be included in GameStop's reported totals. This is, of course, true. Interesting. Also true, ETF shorting. I want to bold this as well. At least this part of his article is more substantive in terms of why he thinks what he thinks with data. Also true, ETF shorting alone cannot be very significant to GameStop's overall short interest. I mean, that's based on the shares. GameStop has about 480 million shares. XRT trades a good portion. Short interest is 16.6 million shares. So the normal state for XRT is to have short interest amounting to 1x, 4x its shares outstanding with 5 days to cover, which would be insane if it was a stock. But it's not a stock, it's an ETF. And as mentioned, specialty ETFs are widely used as market hedges, so this dynamic is not uncommon. The 33% is an average across all ETFs. Yes, even if short interest on XRT is 100% held by directional market players, that is a short on just 800,000, 1.6 million GME shares. 800,000 to 1.6 million. Which is not a lot. So based on the numbers of XRT's share count, BURRY doesn't think that using XRT to short GME is possible or meaningful. So in other words, like he doesn't really think that BURRY doesn't think phantom short interest is possible based on his understanding. And I think that's to hold in general, but to me, it doesn't explain some of the events of GameStop's stock. Like, for example, back here, when Melvin Capital announces like, hey, we've closed our GameStop short position. It's like, okay, if you've closed your short, then you should be fine. But then, a few months later, now they're bankrupt. They're closing, they're going under. And it's like, I thought you already closed, And we know that the reported short interest on GameStop declined substantially after this, the buy button's frozen, etc. But there's still so many moments of intense volatility, right? Where, okay, it's at 10, now it's at 66, right? Like how do you 7x in 2-3 weeks time when the reported short interest at this point was already, similar to what it is now. And even the short interest that BURRY describes from April to June, like it's just so many moments where I'm like, well, what is happening then? Like, I don't really disagree with BURRY's article, but then like, what is the catalyst then for GameStop to go from 40 to 62 in 2 weeks in May, right? Or from 23 to 41 in 2 weeks another year later, right? No, there were no news on any of these things, right? So I feel like it'd be fair to say that GameStop has traded most of the past 5 years totally on technicals, but not from a chart basis, not a beautiful technical like structure being built, but basically some type of short settlement is obviously highly influencing the stock in terms of how it's traded historically. And I think it's just kind of cheap for BURRY to be like, yeah, but not possible. It's like, okay, well then what? Like, then why? Right? Like, Zamora says legal protection so he doesn't get sued. Patrick says BURRY of all people should know that things don't happen as they're supposed to in dark financial markets. This was literally his entire frustration in The Big Short. Benjo says, woohoo! What's up, Benjo? PBPB says, no section on the completely fraudulent system. Yeah, I mean, it just feels a lot of like what he's saying is how the system's supposed to work, but not very catered to what's actually happened in GameStop stock, Direct registration. The most impressive and widespread short squeeze thesis in action is the DRS movement. Let's go. Y'all know that 100% of earnings of this channel go to DRS book GME shares. The idea is simple. If enough people direct register their shares, the float will shrink so much that a big short squeeze will happen when so catalyzed. I mean, I wish BURRY would have rephrased this to the true, simple idea, which is that hypothetically, if the entire float was direct registered, then no shorts would be able to exist. So like shorts would mathematically have to close if all of the shares were held in computer share. right? Shorts can only exist from shares held in Seed & Co., not from DRS booked GME shares. The way Curry phrases this is basically he's minimizing the impact of DRS by saying that we're so small, right? Like if enough people do it, the float will shrink by so much. If enough people do it. Like, I'm not really saying everyone. Is it likely? Is it plausible that 100% of the float gets DRS booked? No. But if that happened, yes, every short would have to close. So anyways, I feel like he's kind of avoiding the real topic here. He says, again, I need to go back to my direct experience. As an activist, I persuaded GameStop to buy back. Okay, you talked, whatever, to the old guard. As an activist, I was in cahoots with the old guard of GameStop. While reported short interest was regularly well over 100% versus 15% today, and nothing happened. So I enter this argument doubtful. Does GameStop hold its shares in ComputerShare? I don't even know if they do. But regardless of if they do or not, like, again, Burry's saying, like, well, look, the magic number is too high to get this to force the squeeze, and therefore it's not worth talking about. But Burry plays both sides of the coin here, because earlier in this article, he was talking about the squeeze that happened on GameStop stock, right? He talked about how he went from whatever 20 to 140 a share or something, and he sold, like, he made a bunch of money on what he felt was caused by his influencing the company to buy back their stock. And now he's saying nothing happened. It's like, well, earlier you just said it went up by a bunch and you made great money. So which one is it? Right? Like, I don't know why he's dismissing DRS when he's also claiming that his advice for GameStop to buy back shares did meaningfully move the needle on their share price, and he was able to capture really impressive gains on his GameStop position because of it. And that was only 30% of the stock, right? So what if 100% of the shares were DRS, right? Like, just engage with me in the hypothetical, and then we can talk about, well, what's the number that breaks the critical mass, right? What would be the straw that broke the camel's back? And is it 100 or is it 90 or is it 80 or 70 or 60? Like, we can talk about that, sure, but it would force shorts to close, like, factually, if it were 100%. Even with all the fraudulentness of our current financial system, because you remove it from that system, right, when it's at the transfer agent. Anyways, 69.4 million shares are held at ComputerShare. It's 366 shares per account, 89,621 accounts at ComputerShare. Really remarkable participation. You gotta love that. That 15.5% of shares outstanding is not available as lendable float for short sellers. Okay, thanks, Burry. We're finally getting there. It turns the reported 15% short interest as a percentage of float into 19%. That's huge. What's up, Charlie? Glad you're here. Why does he say not much effect? Like, that turns the reported short interest, that increases it by what, 30%? 25%? What's 4 divided by 15? 27%. You're calling that not much effect? I just feel like Burry, like, honestly, I feel like Burry, who's often a short seller, is trying to do his best to protect his future shorts, to dissuade retail investors from buying and DRS booking shares of companies that he is short. Like, I just think he doesn't want to get squozen. And so that's why he's saying, oh, it's all pie in the sky. Look, not much effect. A 27% increase in effective short interest. And that's just right now. That's with the stock having done nothing for 4 years now. We're trading flat. GameStop's at the same price now that it was January 28th of 2022. So a stock that's trading flat for 4 years. Imagine if we actually do hit a rally in this next week or in this calendar year. You really think that 15.5% is going to stay 15.5%? If GameStop sees significant appreciation, if they squeeze again, more people are going to sell more than they did in January 2021. And they're not going to sell forever. They're going to sell in anticipation for another crash, and they're going to buy back in. And this time, they're going to DRS book a chunk of that, right? Not everyone will, but the DRSers will. And so, anyways, I disagree with Burry as far as how he paints the impact of computer share and the DRS movement. For much of 2018 to 2020, short interest was over 100% of outstanding shares. But like you just said, all the shares that are lendable, or all the shares that are DRS booked, are not available as lendable float. So he's arguing that, like, look, GameStop can support a short interest of over 100%. But that only works if there are shares available to short, right? If they're all DRS booked, they're not available. The reason that a buyback of 30% shares did not cause a short squeeze was because it happened slow enough for the system to adjust. And that's what's happening today with the DRS movement on a much smaller scale. It's too slow, he says. GameStop, with this Swedish broker who discloses how many of its customers are direct registering shares in their accounts, peaked at over 30,000 accounts during January 2021. This month, that figure is 13,000, from 30,000 to 13,000, which is down almost 20% from just year over year. This attrition in the GME DRS registry got a boost in April 2024 upon the return of Roaring Kitty, but is trending again. This is huge. Michael Burry is saying this as a reason why the DRS book movement is not important, but he is saying that the demand to DRS book shares spikes in moments of volatility. When the stock squeezes, more shares are direct registered. And in January 2021, it was almost 3 times as much. And that was 5 years ago. Do you know if GameStop squeezes again now, do you know how many more people will already be on the right side of the trade, already ready to capture gains globally? So if it was 3 times as much on last squeeze, if it squeezes again, how much more percent of the float do you think will end up being direct registered? Right? Like Michael Burry saying that right now it has intense attrition and is down to just 13,000, down to almost a third of the level of what it used to be. And he's saying that this figure that's down 70% almost is what? Really remarkable participation. He's saying it's incredible. And this is low. So if GameStop spikes, how much higher do you think that becomes? And if it's remarkable now, well, wait till you really see what really happens, you know? We're not seeing gains. Yet 4 years of trading sideways. DRS shareholders are believers in the stock, and that's a valuable part of any shareholder base. So he does think it has value for the stock, that there's a retail base that believes in the stock. I do not believe the DRS movement has momentum. It doesn't right now, but it will if the stock turns. And in any event, does not have the dynamics to be considered a short squeeze threat. Disagree. But agree if everything continues how it has, right? Like it would have to be. His argument is it's happened too slow, and it's not a high enough percentage. But what he's also revealing is the other side of the coin is if it happened faster and if it got to a higher percentage, yeah, I mean, that's definitely a short squeeze threat. Like he's just saying why he doesn't think that will happen, which I think that's fine. I don't really strongly disagree with that, but he's also saying it would happen, so a little sneaky there, Burry. Total return swaps. Let's wrap this thing up. Let's try to get this thing done. It's 11 o'clock. I'm starting to feel sleepy. Woo! Total return swaps. Fundamentally, on the face of it, swaps are a dead end when looking for hidden shorts. Oh, everyone knows that. Okay, Burry. Now you're using generalizations that are a little bit dehumanizing, a little bit like, why would I even talk about this? Anyways, every swap requires a counterparty. If I do, the counterparty will hedge its risk. See, that's an assumption. It doesn't have to. It says that means the short interest in a total return swap is a part of the reported short interest. That's only if they do hedge their risk. So again, he's talking like in generalities. He's not talking about GameStop. What if a whole bunch of swaps were entered into GameStop and the counterparty did not hedge its risk enough? You know what also hedged its risk? The Titanic. But it didn't hedge its risk enough. It didn't pay attention to the stupid radar, didn't have enough stupid lifeboats on the boat, but it had some lifeboats. It had a radar. It had some crew on it, right? It hedged its risk, but it just to assume that everyone will do what they should do as a reason for why total return swaps are not a risk or a method by which short sellers could be hiding shorts is such BS. Like, of course they could be. If this is all his argument, it's kind of crazy. Whatever, you know what I mean, Rusty. The radar, they had the walkie-talkie thing, the control room, they were talking to each other. There's the other boat that kept trying to chime in to say that it was, the iceberg's coming, and they never responded to the walkie-talkie thingy. You know what I'm talking about. I'm not even sure if I've seen the whole movie, to be honest. What's a total return swap? Very simple. If I want to short a stock without borrowing it, I agree to pay a counterparty ongoing interest payments to give me the same return as shorting the stock. The way a counterparty does this is by shorting the stock itself and reporting it, or agreeing to the swap if they don't think they're going to have to pay out, right? But usually, right, they should, right? Most ominously, Citadel. This gives rise to the suspicion that market makers are using their markets, not only for ETFs, but also for individual stocks to help smooth total return swap transactions. If this could happen, it would result in shorted shares being naked and not reported, but it cannot happen. Why not? The market making exception by rule is only for ETFs in the context of the operational shorting described by Professor Evans. To take the risk and run a flow of naked short positions in individual stocks would be an abuse of the privilege that could severely damage the whole firm. Oh, really? So why did the SEC do a whole report on what happened with GameStop in 2021? Is it because everyone was following the rules? Right? Look, we have a rule. Okay, so what's the governing body for the players in the rules? Right? Oh, you're self-governed? Oh, the rules are self-reported? Oh, the SEC is basically a conglomerate of former executives at all the major player, too big to fail firms, right? Like, no one would do that because that would be an abuse of privilege. No one would do that because that could cause severe harm. This is so weird coming from Michael Burry, the star of The Big Short. Like, weren't you there in 2008 and 2009 when all of America got screwed? Was severely damaged by the firms? You know what I mean? Like, it's just such a weird argument. Again, I don't even really disagree with what he's saying, but I don't understand why he thinks that the rules would never be broken. And why firms are so altruistic that they would never abuse their power when every single one of these firms he mentions has lists and lists and lists of like breaches of duty that then they have to pay fines for and whatever. I'm like, anyways. In any event, if there was a lot of demand for them, even without disclosing short position, one should at least expect the borrow rate for the short position to rise. This did happen in 2020 before the big short squeeze of GameStop. Borrow rates were double digits, up to 90%. Rules on risk exposure and margin swaps have been changed dramatically since those days. So I think this is super valid for Michael Burry. I don't know enough about all the technicals and plumbing of the market to really argue with this, but I do agree that you should, right? You should see borrow rates go up if the risk of a short squeeze, like if the shares are getting harder and harder to come by, you should see higher borrow rates, right? The only thing is GameStop is such an exception that it is so highly watched that there are so many people that are still long the stock, that are still holding on for a short squeeze, and it is in the best interest of anyone and everyone that's on the wrong side of this trade. If this trade really did start back in 2012 or in 2008 or in 2016, like how many years of intense shorting are still needing to be unwound, and how many institutions are on the hook if it is an existential threat, right? Like the Thomas Butterfly, whatever his last name is, Petterfree, something like that. The CEO of Interactive Brokers, when he was describing just how at risk our entire financial system was in 2021. Anyway, like if GameStop is still an existential threat for our global financial system, then I absolutely would expect every rule to be broken and nothing to make sense. I would not expect there to be any sign on the surface that huge amounts of legacy short positions are still in the mix because it's public, because we live in the internet age, right? It would cost every government, every institution too much. There are no winners on the side of the trade, right? Everyone was short. That's the one thing with 2008 is Michael Burry and a couple other firms were the big winners, right? So it's a little bit different in and the scale now compared to then is probably many magnitudes higher. So anyways, it's just like I agree you should see this and we might see it, but I think there would like I would not expect the system to work how it normally should just in the case of GameStop in particular. But is Michael Burry being a bad actor in all of this? Or is he just genuinely sharing what he thinks is reliable information and he does not think GameStop's the exception? You know, I think it's either side of the coin is probably possible. So anyways, then he goes into the borrow fee coming up. Rebates then fall. Then he shows an example of like hard to borrow period. I'm not going to go through those charts, but it's all related to borrow fee should be higher when short interest is higher, basically, even if short interest is not being reported. Quad witching. For all those situations, total return swaps may be used, which can cause a spike in demand for shorts by the counterparties, which puts pressure on borrowing costs. However, illegal naked shorting is not necessary for this kind of disruption to happen. And away from these quad witching periods, the GameStop fee and rebate charts return to general collateral conditions, meaning easy, low-cost shorting 9 to 10 months of the year. If total return swaps, illegal naked shorting, or troves of hidden short shares were out there, then we would see borrow rates increase, and this is not the case. I do not believe total return swaps should be a significant issue for GameStop shareholders, and that about sums it up for short squeeze theories. So that's what he said, and that's what I said about what he said. Final thoughts. At this point, the value of GameStop is in a young 40-something Ryan Cohen and the optionality of many billions in his hands. So, as I've said a lot of times, I agree that these are parts of the value. I disagree in the ways that Burry devalues the retail business and devalues power packs. But I agree that GameStop's opportunity to create more value is greater through Cohen leading the asset management business. I think the value that can be created there is higher than the value of the retail and power packs business put together. But I don't think it's like the only value. He also says the value is not in another big short squeeze or MOAS. And I would disagree. I think there is some value in the prospect of a short squeeze, in the prospect of MOAS, in the prospect of even miniature squeezes and moments of volatility. I think all of those are valuable aspects of buying at these price levels. GameStop has done something curious. It has grown its net asset value per share tremendously, even as the business shrinks. Most everyone on the planet knows that GameStop has been shrinking its store count dramatically. The operating business is in practical liquidation. That is not true. Okay, get out of here with that bullcrap. They're not liquidating the retail business. Jeez. They did liquidate the international parts. Whatever. The other thing that is obvious is GameStop keeps issuing millions and millions of shares, yet tangible book value and tangible book value per share are going up. It seems curious. However, when a company issues shares well above intrinsic value per share, intrinsic value per share goes up. It's expected. Simple math. We can use tangible book value as a proxy for net asset value. GameStop raised $3.5 billion by selling stock in May. That stock was sold 5 to 8 times tangible book value back then. which has since more than doubled. So in the end, they're raising more cash, but they're basically raising the value of their business faster than the rate of their dilution. Issuing so many shares way above tangible book value also increases the value of the old business and therefore helps preserve a larger portion of their $1.2 billion in net operating losses. Ryan's plans appear to be raising more cash with another stock rally into the 30 range. This is the idea behind the warrants and the two big debt offerings. Where am I? He has to be careful not to issue too many shares, though. And there is a 50% ownership change within a rolling 3 period, which would significantly limit the use of those NOLs. So we know that they're, honestly, this is so wonderful that Michael Burry said that, because I didn't even know that. And that basically just gives a clear cap to how much dilution is coming, because they're not going to give up those NOLs. There's a good chance that the debt offerings and warrant issuance are part of the plan to space out the 50% ownership change in order to avoid losing the NOLs. $750 million are unrestricted and can be applied to U.S. taxes, not an asset to lose. The NOL shelter also makes any business GameStop buys cheaper for it than almost any other buyer. The tax-free post-deal cash flow will be larger and can support a higher price for a bid. During 2025, tangible book value per share grew again on the power of the interest that the cash was earning. And since the debt is a positive carry situation, the debt adds to the tangible book value per share through earnings. When Warren Buffett ended his hedge fund in 1969 and turned his focus on Berkshire Hathaway as a holding company, he began what was then a somewhat unique way of measuring the performance of his corporation. From the Berkshire Hathaway 1979 shareholder letter. So let me see if I can find the little snippet from that letter. What is the snippet from the letter? They say in the letter, most companies define record earnings as a new high in earnings per share, since businesses customarily add from year to year to their equity base. We find nothing particularly noteworthy in a management performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding. Except for special cases, like companies with unusual debt-to-equity ratios or those with important assets carried at unrealistic balance sheet values, we believe a more appropriate measure of managerial economic performance to be return on equity capital. In 1977, our operating earnings on beginning equity capital amounted to 19%, slightly better than last year and above both our long-term average and that of the American industry in aggregate. But while our operating earnings per share were up 37% from the year before, our beginning capital was up 24%, making the gain in earnings per share considerably less impressive than it might appear at first glance. So, Ryan is making lemonade out of lemons. He has a crappy business. He has a business that used to be crappy, I would say, and he's milking it best he can while taking advantage of the meme stock phenomenon to raise cash and wait for an opportunity to make a big buy of a real growing cash cow business. I agree with this, although I would argue that PowerPacks is one of those that he is buying. He's investing in it with GameStop capital, and it will be a growing cash cow business. But I think there are bigger fish to fry to come for sure. He also has an incentive to keep that old business around, bringing in $1 billion or $2 billion of revenue, because that old business is necessary to access those NOLs in the event a 50% ownership change does occur. Therefore, Ryan likely cannot shut down the old business entirely or shrink it too much more. He's not going to shut the old business down. Why are you hating on a business that just printed $569 million in free cash flow? Like, why is he such a hater? What's more, if GameStop buys another business, he has to make sure the old business is still alive and kicking for at least 2 years after the acquisition in order to keep the benefits of the NOLs. These are rules that Buffett was very careful about in the 1970s. If I'm Ryan now, I want the stock to rally into the 30s. I want to raise cash through those warrants. I want to get rid of the debt by issuing equity, meaning convert the convertible bonds. The stock in the 30s would move that along. If it goes higher, issue more stock, but not too much so that you don't squander the NOLs. After that, GameStop would have no debt, $1.9 billion from the warrants on top of the convertible cash that would already convert, that extra $4.2 billion, with a small operating business throwing off something and validating the whole thing for a while longer. Right, so you renew investor support, retail interest, give yourself a longer runway. Tangible book value could reach nearly $20 per share, right? Their actual cash floor would be at $20 a share. And if GameStop is at tangible book value in the near to intermediate future, at current prices, I would be buying my capital allocation expertise as well as any new business developed or acquired for free. Basically, if you think GameStop's cash floor is their actual cash, right? Based on the cash that they have, the convertibles that will dilute, plus the $2 billion from the warrants, even net of the dilution that would come, you end up at $20 a share of just cash that they're going to have. And if you know that's going to happen, and you feel with a high level of clarity that's going to happen, and right now you can buy the stock at $20 a share, which you could a week ago, literally 1 week ago, guys, then anything else they do, right? The capital allocation expertise, aka Cohen, his expertise, any new business they develop or acquire, you get all of that for free. And by the way, the enterprise value of Power Packs and the legacy retail business. Burry just doesn't mention it here because he doesn't value those. But you get everything for free when you're buying GameStop at 20 a share, because they're going to have that much just in cash, likely before the end of the year. Maybe the stock could default back to the new 20 level, or even to the low 10s on a big market crash. Nice. Nice. Let's go, Burry. Let's go, Burry. Swinging that thing around. He said, go ahead and try me, short sellers. Yeah, maybe it'll even go to the low 10s. I could deploy my personal billions to buy back more GameStop stock and increase my ownership stake, all while protecting those NOLs. Love it. The same events may make it easier to deploy my $11, $12, $13 billion cash to buy something great. An insurance company with the right characteristics and investable float like Geico, or any of the already numerous businesses in this valuation range that are already cheap and will surely get cheaper. Notably, this very month, GameStop's board approved a new comp plan for Ryan. Great. This is a play to greatly increase his ownership of the company. Of course, he has to reach the milestones, market cap, and EBITDA thresholds. This is the deal I would want if I wanted more ownership and was sitting on a growing giant pile of cash and had planned a transformative acquisition or acquisitions. Beautiful. I agree. The comp plan for Cohen communicates that GameStop has a plan to add transformational value to the company. I, of course, believe. So did he actually say Molina Healthcare, or is this just like a wrong transcript? He did say Molina Healthcare. I don't know why it's talking about that. I missed that. As an acquisition target. Is it great by now? A private equity fund will likely snap it up if it stays this cheap, but there will be others, right? Things that GameStop could acquire. Then I proceed to live my life doing my best Warren Buffett impression, patiently buying all or in part great businesses and doing sweetheart financing deals in tough times. Ryan could do it. He is circumspect enough, patient enough. I do not know about this Bitcoin thing, but I cannot argue with what has been done so far. I own GME. I have been buying recently. I expect I am buying at what may soon be 1x tangible book value, aka they're going to have $20 per share worth in value, just net asset value, like cash. And I'm getting a young Ryan Cohen investing and deploying the company's capital and cash flows, perhaps for the next 50 years. That is not a common occurrence, right? The comp plan adds value to GameStop because it ensures Ryan Cohen's tenure is at least going to be that long. It's probably not going to be 50 years till the comp plan vests. But if this comp plan gets approved, it means that a similar one like it would likely get approved after this one gets fully vested, right? Just like Elon Musk did. So to the runway of his working expertise is quite possibly 50 years. And his wealth concentrated in GameStop would likely lead him to want to continue working for the company, given how much he owns of the company, right? And that is not a common occurrence at all. And the downside is protected with that cash per share floor we're talking about. So being long GameStop is almost as asymmetric as it gets. This is huge. This is Burry's way of saying the risk is so freaking low and the upside is who knows how high. The upside is Ryan Cohen for 50 years with 10 billion to work with. Like that's the upside. I believe in Ryan. I like the setup, the governance, the strategy as I see it. I'm willing to hold long term. He doesn't say he's planning on it, but he's willing to. And I'm excited to see where this goes. I am 15 years his senior, but not too old to be patient. I'm not counting on a short squeeze to realize long-term value. Now, did I need 8,000 words to say that? Maybe not, but if I did not do all that work, I would have no anchor when markets get tough or news develops quickly. If I did not show the work, the process, the reader would perhaps miss out on an anchor as well. As it is, the knowledge in this document could be that anchor in rougher waters. I align with this. I feel similarly with my channel. Like the more and more we familiarize ourselves with the fundamental value of the company, what's the stock actually doing? What's the company actually doing? The more that we can be resilient and opportunistic when it comes to movement within the actual stock price. When all we do is stare at the stock price all day, it's so easy to get lost in the sauce, discouraged on down days, pumped on up days, and you end up making suboptimal decisions on both. When you focus on the real state of the real opportunity, you have very clear justification in mind, price targets in mind, etc. A fundamental case supports strength and conviction as an investor much more than technicals do and much more than the stock chart does. Developments can be set against the thesis here. Is the thesis violated? Is it simply deserving of change? Should it be abandoned? Doing so with the knowledge that one has done the work is much different than doing it with a few headlines or a gut feeling, common sense conclusion. This is true even if the worked out research conclusion and the gut feeling / headlines conclusion are one and the same. Until next time. So there you go. Let's clap it up. Clap it up for Burry. Thanks, Burry. Thanks, Burry. Thanks, guys. 120 of you guys. 2 hours and 20 minutes in. You got to love it. You got to love it. So he is long, at least for now. I imagine it's kind of funny because he's not he's not super bullish on the prospects. So if the stock rallied to 50 a share, I think that would probably be a threshold that Burry would probably say, I'm going to go ahead and exit. And that's just kind of funny when you think about how Burry got involved back somewhere in here, late 2019 or early 2020, right? Like Burry turned $1 a share into like $3 a share and then sold. And so he was right on, he was first to the squeeze play, and he was right, yet he sold at a double and missed out on a 70x. you know and it's funny because he's, in some ways he's late, but as far as the public consciousness is concerned, he's early to GameStop, the fundamental value play, and yet he's not actually fundamentally that bullish on anything the company's done so far. And he's really just saying the floor is so high that why not just take a chance on Ryan Cohen? But basically, in my opinion, I think he would sell at 50. And so it would just be so poetic if 2 times Burry settles for a double and misses out on an epic GameStop squeeze. That's what I think he's setting himself up for. But maybe keep holding Burry, maybe keep some of the shares, maybe just trim some of your shares at 50 if you really don't believe in it that much. But he believes in it enough at this valuation to own a position, and you got to love that. You got to love it. But I do think he is setting up some language in this thing to defend, to protect himself as a future short seller and discourage the retail enthusiasm to basically take the inverse short seller trade. I think Burry sees that as a threatening trend, and he's hoping that that doesn't take root. Anyways, what else am I missing on the comments here before I go to bed? What's up, Jet? Gazua? Love to see you guys. Can you talk about the Bitcoin loss in value? We'll do that in another video, Ken. There's still 5 days left till Bitcoin gets priced for Q4. But it will not affect operating value at all. It will not affect operating income. Citizen Detroit. Oh, you're talking about how many stores will they have closed? Okay. Rusty says, this is atypical. GameStop's book value will rise significantly if all dilution transpires. It's true. Adam Enron says, this channel's going mainstream, my man. Thanks, dude. Thanks, Adam. Goofy Goofball says, you might want to stop discounting Burry's bearish attitude. Your optimism blinded you last earnings call and really skewed your earnings prediction. Yeah, I mean, my optimism was not really the issue. My issue was that I abandoned my fundamental model for GameStop's Power Packs business, and I YOLO'd. I full sent it on Ryan Cohen's interview, and I also was totally like unaware of how much pent up demand there was for the Nintendo Switch. And I wasn't, I didn't do a fundamental bottoms up valuation for hardware. And I was just looking at year over year, quarter over quarter, and console over console trends. And those led to an estimate that was way off on the hardware. But if you watch my old video, I did a video kind of backwards thinking if I had done comparisons based on the Switch sales that Nintendo reports like what would my estimate have been if I had done a bottoms up analysis, even with all my optimism. And I was like right on the money. And my bottoms up analysis on power packs and collectibles from a bottoms up perspective, we're also right on the money. So if you take the best of everything I've done, I've definitely been all over it. But that interview threw me off big time. And power packs wasn't even reported. It's equity accounting, right? It's a joint venture. It's off balance sheet right now. So anyways, I appreciate the advice though, goofy goofballs. And I'm not trying to be like, I'm not trying to say like nothing could ever go wrong. Like I'm saying even my bearish valuation on GameStop, the retail business, like even the low end, I'm like, this is definitely worth some billions of dollars, even if everything goes like real bad, you know. And if it just goes fine, it's worth, 6 billion, and then another billion on power packs if it just goes fine, So I'm not like, it's fine with me if someone is super bearish, but to act like the retail business is doomed and GameStop's just dragging it along, and that power packs is like there's no way it could sell a meaningful amount of packs because YouTube videos don't get a lot of views. Like from a bottoms up analysis perspective, I just don't think that's very informative coming from Michael Burry. Like I think he could have done a more thorough job there, but I agree with the general sentiment of like there's nothing super exciting happening within retail, and power packs is not like incredibly needle moving, but like I just wouldn't be as pessimistic as Burry, where he basically just wipes them right off the table and is like, okay, so those don't matter. So what are we doing here? I'm like, and again, it's all relative to the valuation. GameStop right now is only a $10 billion company. So to say their legacy retail business is worth $3 billion, and on a bearish sense, it's worth $3 billion. Well, like, shoot. Well, if they're going to have 12 in cash within this calendar year, then yeah, another 3 billion. I mean, that matters a lot, and that's what I'll say about that. But I agree. I mean, we're all trying to be level-headed here, level-headed fundamental analysis. If I ever get so speculative, and I'm not talking about fundamentals, that's when you really want to put your ears up and be like, wait a minute, something's not going right. If we're all just dancing, everything's going to the moon, who knows why? Just put, bet on red. It's all going up. That's when you know something's wrong on the channel. But if I'm incredibly optimistic from a bottoms up fundamental perspective, that's fine with me. Let's see. Yeah, some people said perhaps he knew what was coming and didn't want to be a part of it. Paper hand Burry. Yeah, I mean, I think if he said in his first letter he didn't know that the squeeze was coming. I think if he did know, I think he would have said, hey, you know what? How much do lawyers cost again? 77x my investment. And then I have to pay how much in legal fees? Like, I think he would have taken that any day of the week if he knew it was coming. I don't know how to say your name. Machuca said if he alluded to having billions and he truly believes downside risk is so small, why hasn't he filed an SEC form for 5% ownership? It's because he's not bullish on GameStop. He just thinks he only thinks it has a very high floor. He does think Ryan Cohen might have something really valuable up his sleeve, but he doesn't think there's anything really valuable in what GameStop has done so far, but he thinks the dilution map ahead of them just creates such a high cash floor. Just the return on cash is so compelling that it's worth taking a flyer on what they might do. He basically is investing with the thesis that some of retail investors were investing starting like 2 years ago, where they say, great, it's not going bankrupt, like it's going to make money. And so now it's just what's Ryan Cohen going to do? And now 2 years later, it is making a lot of money. Turns out the stock hasn't done anything in 2 years. And Burry's saying, okay, shoot, well now with another $9 billion in the bank and $500 million in free cash flow, and it's still sitting at the same price it was, like, yeah, I mean, it's basically a free business, is what Michael Burry said. Not doing but the thumb war between Buffett and Cohen. Yeah, it'll be fun to see. Busy week, dude. Thank you for the read and breakdown. Thanks, Boom Boom. Stussican, if that's what you say. So sorry if my comments are a bit unhinged, but glad you're streaming and glad to be here with you. Glad you are here with me too. Thank you guys for the likes. Thanks for the subscriptions and the engagement on the channel. Trying to add value, trying to give level-headed fundamental analysis to the GameStop community. Adam Enron says, what other stock has a live community? Am I right? I mean, well said. Well said, Adam. We like the stock. Really excited to see what the market does tomorrow and this coming week. But I did want to cover Burry's thoughts because some good thoughts in there. Overall, some of them not entirely compelling to me, but mostly like very well presented. And mostly I probably agree like 85-90% of what he said. So some of the stuff I'm laughing at him, but we're not that different. You know, he says Power Packs is cute. I'm saying cute. This is $1 billion at least in long-term value that's going to be created. And that's a 10% gain from the current market cap. So again, a lot of the things were I'm being kind of boisterous, but really Burry and I see things very similarly. Ultimately, like this is the long-term upside is what Burry's saying in this article, which is what Roaring Kitty said in his live stream a year and a half ago, which is a bet on Ryan Cohen and the deployable cash of GameStop. What will they do that they haven't done yet? What's up their sleeve that they haven't communicated yet? That is the biggest opportunity, the highest upside fundamentally within GameStop. I totally agree with that. I just think the medium term, even if there's not a big announcement, is actually still quite exciting from a fundamental perspective because of the impact of that cash flow that they're generating, what that does to their valuation on a PE basis. And I'm much more bullish on collectibles as a whole than Michael Burry is. And I think his bearishness on collectibles is just a little bit too skewed from his personal experience buying baseball cards as a young teenager, young 20-something, and not enough entrenched in the data of collectibles. I mean, basically he's writing off the data saying it's a fad. And there's no way to argue against that unless the only way to prove that it's not a fad is for it to continue to gain value over time. And so we'll see, right, if it does or not. But I think fundamentally that the support for store of value through collectibles is really rich and really present. All right. That's all I got for y'all today. Ryan GME says, to the moon. To the moon. I'll see you there tomorrow, guys. Let's go. All right. I'm closing this thing. I'm going to go to bed. I got to blink a few times because, a lot of reading there. Love you guys. Talk to you later. That's all I got for y'all today. I'll see you in the next one.